Hi, and welcome to Economy and World. Today we are going to discuss one of the most seismic and least understood financial movements of our contemporary era, the total dismantling of the credit dependency between the two largest superpowers on the planet. What was considered for decades to be the pillar of global stability, the massive purchase of American debt by China, has been transformed into a geopolitical weapon of pressure that threatens to redefine the value of every dollar in circulation. The figure of $850 billion is not merely a statistical data point in a Treasury report. It represents unprecedented leverage that Beijing has begun to withdraw, marking the beginning of what many analysts define as the end of dollar hegemony as we know it. This phenomenon should not be seen as a simple portfolio adjustment, but as a state decision intended to erode the financing capacity of the American government at a time of extreme fiscal vulnerability. For over 20 years, the world operated under an implicit pact of mutual benefit that allowed the West to enjoy an era of cheap consumption and easy credit, while China built its industrial miracle at a staggering pace. The mechanism was simple, yet deeply unbalanced. China exported consumer goods, electronics, and machinery at highly competitive prices, and in exchange received dollars that it immediately reinvested in the American Treasury bond market. This recycling of capital allowed the American government to finance its deficits almost for free, keeping interest rates artificially low for the average consumer, thus subsidizing a lifestyle through cheap mortgages and credit cards with minimal interest. It was a relationship of codependency where one produced and the other consumed on credit, a symbiosis that seemed eternal but hid the seeds of its own financial destruction. However, the landscape changed drastically with the intensification of trade tensions and the imposition of 60% tariffs in this convulsive year of 2026, which broke the cycle of trust and transformed a necessary trade partner into an existential adversary. China has understood that holding promises of payment from a hostile government is an unacceptable strategic vulnerability, especially after closely observing how the foreign reserves of other nations were frozen overnight for purely political reasons in recent conflicts. In response, Beijing has initiated a systematic and silent de-dollarization, shedding its holdings of American debt at the fastest pace since 2015, opting to diversify its capital into real and tangible assets that do not depend on the goodwill or the political stability of Washington. This strategic shift manifests itself with particular force in the massive accumulation of physical gold, with 28 consecutive months of record purchases by the People's Bank of China, seeking a refuge that has no counterparty risk and cannot be blocked by a Western-controlled SWIFT system. While the American Treasury issues more debt to cover an annual deficit that already exceeds $2 trillion, it is met with the harsh reality that its largest customer has not only stopped buying, but is flooding the market with its old bonds. In the complex world of international finance, when the supply of bonds massively exceeds existing demand, the price of these assets collapses, automatically forcing yields and interest rates to skyrocket in a desperate attempt to attract new investors. The most immediate and devastating impact of this phenomenon is felt in the residential real estate market, where the 30-year fixed mortgage is intrinsically linked by financial mathematics to the 10-year Treasury bond yield. If the massive sell-off by China pushes the yield of these bonds toward critical levels of 6 or 7%, mortgage rates must rise proportionally, potentially reaching levels of 9% or more in the extremely near future. An increase of this magnitude not only halts the purchase of new homes, but destroys the real estate wealth accumulated by families, as property values tend to plummet when the cost of financing becomes simply unreachable for the vast majority of citizens who aspire to own a home. From a structural and professional analytical perspective, it must be understood that we are entering a new era that experts call fiscal dominance, where the massive volume of public debt matters far more than the monetary policy decisions of the Federal Reserve. For decades, the narrative was maintained that central banks had absolute control over the economy by adjusting short-term rates. But today, that is an illusion that vanishes in the face of the brute force of the bond market. If international investors decide that the risk of default or inflation is too high, long-term rates will rise regardless of what the Federal Reserve proclaims in its press conferences, completely neutralizing the ability of politicians to save the real estate market or stimulate economic growth. The fragility of the current banking system aggravates this crisis exponentially, as American financial institutions carry unrealized losses exceeding $600 billion due to the fall in the value of their bond portfolios. Banks operate under the premise that their deposits are invested in safe assets. But when interest rates rise sharply and unexpectedly, the market value of those assets decreases drastically, creating a hole in their balances that only remains hidden through accounting tricks. The moment depositors require their cash or the market demands immediate liquidity, the bank is forced to sell those bonds and recognize the losses, which can trigger a systemic insolvency crisis that would jeopardize the stability of the entire national payment system. This conflict is not confined to the realm of spreadsheets. It is a form of asymmetric warfare in which China uses the West's chronic addiction to debt as its primary instrument of diplomatic and economic pressure. By pushing interest rates higher through the sale of bonds, Beijing has the ability to trigger a deep economic depression without firing a single shot, directly affecting social stability and the refinancing capacity of thousands of corporations. It is a direct exchange of strategic blows. While one power blocks access to semiconductors and advanced technology, the other responds by cutting off the flow of credit that sustains consumption and productive investment, fully aware that the economy of the United States is far more sensitive to changes in the cost of money. At the same time, the collapse of the petrodollar system is eliminating the structural demand that once supported the value of the currency of the United States in international trade, in energy, and commodities. China, as the world's largest oil importer, is closing bilateral agreements to pay for its supplies in yuan or through barter arrangements, bypassing the traditional financial system and reducing the global need to hold dollar reserves, now forcing the domestic economy to confront the real cost of its accumulated debt and chronic fiscal indiscipline. The current situation poses an existential dilemma for financial authorities in Washington, who are trapped between two options that are equally catastrophic for the nation's long-term future. The first is to allow market forces to take their natural course, which would inevitably lead to a massive deflationary depression, widespread bank failures, and a collapse in the standard of living of the middle class due to a lack of credit. The second is to force the Federal Reserve to print trillions of additional dollars to absorb the debt China is selling, temporarily rescuing the financial system, but at the cost of destroying the $AS purchasing power through runaway inflation that would wipe out the savings of the entire working population. We are witnessing the exhaustion of a 40-year model of globalization that is now unraveling in just a few months under the pressure of geopolitics and inescapable mathematical realities. The most sophisticated investors have already realized that traditional safe havens, such as sovereign bonds, no longer provide the protection they once did in a world where debt itself has become a weapon. Global capital is entering a transition toward a multipolar system in which credit is no longer a guaranteed right, but a scarce resource used to reward allies and punish adversaries, permanently reshaping the cost structure of every company operating internationally. Equity markets appear to be ignoring these warning signs with alarming complacency, betting that a government rescue will always be available to prevent any meaningful decline in prices. The bond market, however, by nature deeper and more cautious, understands the uncomfortable truth. The financial safety net has been worn out by overuse. In the past, technical liquidity mechanisms such as reverse repo facilities efficiently absorbed system shocks. But those cash buffers are now depleted after years of uncontrolled public spending and monetary stimulus that have saturated the private banking system's capacity to absorb liquidity. Without that liquidity cushion, every new wave of selling by a major state actor, such as China, sends shockwaves instantly through the entire global financial system, increasing volatility and the risk of a systemic accident. It must be remembered that Treasury bonds are not merely debt instruments, they serve as the primary collateral for nearly all financial transactions worldwide, from derivatives trading to interbank lending. If the value of this collateral becomes volatile or unreliable due to large-scale foreign selling, the entire scaffolding of global credit begins to shake, raising transaction costs and reducing the efficiency of capital markets. As large corporations are forced to refinance their debts at interest rates that have tripled compared with the previous decade, the impact on employment and real investment will become painfully evident for ordinary citizens. Many companies that survived artificially thanks to cheap money will confront the reality that their business models are not viable under the new regime of positive real interest rates. This is the inevitable price of having built prosperity on external debt issuance and the consumption of imported goods, while ignoring the signs that the balance of financial power was shifting irreversibly toward the east. For the commercial real estate sector, the situation is even more critical. Hundreds of billions of dollars in loans are coming due in an environment where office values have fallen and refinancing costs are prohibitive. If the bond market fails to stabilize, we could see a cascade of defaults in commercial real estate that would drag down regional banks, which are the main holders of this type of debt, on their balance sheets. China is fully aware of these structural vulnerabilities and uses its strategic exit from United States Treasury bonds to maximize pressure on these fault lines, seeking to weaken its rival's internal economic cohesion while strengthening its own position through the acquisition of tangible assets. The very concept of safe money is being redefined before our eyes, forcing wealth managers and individuals alike to rethink how they allocate their savings in the face of a decade of uncertainty. Trust, the only real backing of any fiat currency, is eroding as the financial system turns into a battlefield where the rules can change without warning. De-dollarization is not a single event, but a continuous process of erosion in which every failed debt auction and every trade deal settled in alternative currencies strips away another fragment of power from the system that has dominated the world since the end of the Second World War. It is imperative to analyze the response of the United States Treasury, which is increasingly forced to issue debt at shorter maturities in order to avoid locking in high interest rates for decades, thereby increasing constant refinancing risk. This strategy, known as shortening the duration of the debt, makes the national budget extremely sensitive to daily fluctuations in interest rates, creating a state of chronic fiscal instability. Every percentage point increase in rates translates into hundreds of billions of additional dollars in interest payments, money that must be diverted from other public services or more likely financed with even more debt, feeding a spiral that can only end in a forced restructuring or a massive devaluation. China's quiet withdrawal through intermediaries in financial hubs such as Luxembourg or Belgium suggests that Beijing is trying to avoid triggering a sudden panic that would collapse the value of its remaining assets, opting instead for an orderly but relentless exit. This drip-feed strategy keeps constant pressure on bond prices, preventing any meaningful recovery and ensuring that interest rates remain at levels that inflict maximum financial stress on the financial system of the United States. At the same time, the use of custodian banks obscures the true scale of the selling, leaving analysts in Washington trying to guess how much leverage the Asian power still has to continue pressuring markets. From a macroeconomic perspective, the gap between the real economy and financial markets is closing in the most painful way possible, through the convergence of debt costs with the reality of capital scarcity. There is no longer a marginal buyer willing to absorb excess bond supply out of patriotism or inertia. Every invested dollar now demands a risk premium that reflects geopolitical instability and inflationary danger. This shift in investor mindset marks the end of irrational exuberance in sovereign debt and the beginning of an era of financial realism in which the solvency of states will be scrutinized as harshly as that of any private company. In conclusion, what is happening in the bond markets of New York or in the strategic offices of Beijing is not remote from everyday life. It is the decisive factor that will determine who preserves their wealth in the years ahead. The financial storm described here is not a bold prediction, but a direct reading of the capital flows that are already abandoning the traditional debt system in search of more solid and less politicized refuges. Only those capable of reading between the lines and understanding that the global credit system has entered a phase of open warfare will be able to position themselves to protect their assets from the devaluation and instability that will define this new era of fiscal dominance and geopolitical conflict. The financial world is witnessing the end of an 80-year debt cycle, and China's exit is merely the catalyst accelerating an adjustment process that was, by definition, inevitable given the excesses of the past. Monitoring liquidity indicators, tracking treasury auctions, and following movements in gold will be essential compasses for navigating an environment in which yesterday's certainties have become tomorrow's risks. This concludes our analysis. Thank you for listening.